Mike Tedeschi, Wealth Management Advisor at Perspective Wealth Planning with this week's market breakdown video. As always, if you guys like the content, please subscribe to our channel so you can see this on a weekly basis. In this week, we're going to take a look at the four major U.S. indexes. We'll also take a look at the commodity space as well, the U.S. dollar, and we're going to take a look at the emerging markets and some interesting breadth readings as well. So let's jump right into it here. First and foremost, we clearly have a new all-time high here on the S&P 500, and we have broken out and continued and followed through here this week. That is exactly what the bulls wanted to see here. Did not want to see us turn back down from that all-time high zone, and we clearly have continued to push higher. The Nasdaq continues to be an absolute monster, leading the charge here to the upside. Yesterday, the Nasdaq was up almost 2% for the day, and when we look at the Russell 2000, it was actually red on the day yesterday. So we still have that bifurcation between the tech stocks and the rest of the market. When we look at the Russell itself, we're still having issues right around this 1600 level. We can't seem to get back over it, and there's that really important 1630 zone, which is where we broke down from earlier in the year, that we haven't even made it back to. We look at the Dow. The Dow had quite a shakeup this week. Due to Apple's stock split, they actually changed three components inside the Dow that will take place at the end of this month. Because the Dow is a price-weighted, not a market cap-weighted index. So when a stock splits, it actually decreases its share value, in this case by 25% inside the index, which left the Dow with not enough tech weighting, which is why they had the big mix-up there. So it'll be interesting to see how that impacts the Dow moving forward with that change. However, it should stay the same in terms of the price at the moment, which is the reason they picked the stocks that they picked. But here we are right into resistance on the Dow, and we have not pushed up into this gap either. So, we're looking at the four major U.S. indexes. The same story continues to play out that we have been talking about all year. We are getting lagging out of the Dow. We're getting lagging out of the Russell. The S&P 500 is lagging the Nasdaq, but continues to at least push and make new highs. So tech has been where it's the money has been flowing into, and that still has not stopped. We've seen a couple of rotation days where the Nasdaq would underperform and money would flow into the Russell and the Dow, but none of that continuing. There's none of that extra flow. When we had a movement into the Russell like that with a really strong move up for a day or two, it wasn't able to hold on to those gains, and it slowly slipped back over the next couple of weeks. We look at the emerging markets. We are really right at an important level. So we've looked at this chart a lot here, and we've got a number of lines on it. I am now going to clean this off for you guys. We're going to take a look at this in a completely fresh way. The major level that we've been watching of resistance really is this zone. And so we can see this zone going back 2-3 years. We had a kind of resistance. We fell back down. Then when we finally broke above, this area acted as support, and we kind of held up until we finally made that breakdown. And then we failed there, we failed there, we failed there, and here we are right back into that zone. So this 1100 to 1150 is really that major level that we have to continue to pay attention to here. And on the emerging markets, which have made that comeback, are about to flip green for the year. They're down 0.5% or so at this point in time. And we want to continue to watch this because of what's going on with the U.S. dollar. The U.S. dollar had tried to make that reversal. If I look at this in here on a daily basis, it made that bear flag breakdown and then bounced back up. And looks like it wants to roll back over once again. A weak dollar usually ends up being a good thing for the emerging markets as well as commodities, and that's why we continue to take a look at these in the video. Thursday, today, 27th, Powell is actually talking about inflation metrics for the Fed. This could very much have a big impact in terms of the U.S. dollar and the commodities. I'm making this video before the market opens on 27th, so if we happen to see a big reversal at some point during the day today, I'll definitely cover that in next week. But there is that catalyst for a potential movement based on what Powell does say. And I want to take a look first at oil. Oil continues to push up. It's been slowly grinding. I'm going to zoom in here in an hourly chart from this weekly chart. It's been slowly grinding higher now for a month or so, making marginal highs each time, but it's not really accomplishing much. All right, we're just kind of slowly drifting a little bit higher. We haven't seen any big volume come into oil. Some of the movement up here this week could certainly be in regards to what's going on in the Gulf with Hurricane Laura shutting down some of the production and refineries in the U.S. For a few days. So you have a little short-term spike in the price of oil as supply dwindles there for a few days. We'll see if we can continue to get that follow through, but really what oil bulls want to see is an actual big push here to the upside, a clean, large volume kind of move versus this just slow kind of drifting, if we're going to get that follow through and that continuation higher. We talked about copper in the last video at that $3 level. You can see last week it pushed just above that, and I'm going to zoom in on a daily basis so you can see what happened after we broke that 3 level. We fell back down, and we fell right basically to the rest of that important support zone. It held and is subsequently pushed back up. Still watching that $3 level. What happens here is really, really important. Gold and silver have been very volatile lately. If we look in at silver, we'll look at this on a daily chart. Right, it's holding up over that key 26 level, hasn't really accomplished much here over the last week or so, but these are some pretty big daily ranges. This is 7-8% size daily moves in the price of silver. That is very volatile. So we should get another move here at some point in the near future. The direction that moves is important. Gold also has been very volatile, not nearly the same percentage basis that silver has been, but it's been making $53 daily moves, which is very large for gold. And of course, that has to do with the fact that we've had this big push up, then we had that huge sell-off day down. So volatility is in this space, and we're sort of creating a bit of a wedge here in gold. The gold bulls really want to see that 1870 level hold, which is really that spike low from last week. But the major key important level is really this 1830, that breakout zone from back at the middle of July. That's really where the bulls need to hold on. A break back up really over 1975 would target 2020, and a move back up over 2020 would really set this thing in motion again to the upside. So we're going to continue to have to pay attention to what's going on with the U.S. dollar. And the commodity space, because there's definitely some very interesting moves happening at the moment. Now I want to come in and take a look at the Smart Money Dumb Money Confidence Index. We talk about this a lot. We're starting to get really back to that very stretched zone. Smart Money Confidence is 33%. Dumb Money Confidence is up at that 80 zone. And this is an area where we've seen some issues in the past in terms of price reversing. Usually happens with the Smart Money over 80, but usually at the same point in time, the Dumb Money over 80 and the Smart Money under 20. Right? If we look at the last couple times, we really had that kind of reversal. The Smart Money's been lower. So, we still could continue to widen a bit more here over the short term. But this is, once again, starting to get to that stretch zone. It's one of those things that doesn't matter until it does, and then we almost always see that gap close, over a course of a couple of months. So we'll be watching this for a turning point here in the near future. That would be a good indicator that we might get a little bit of a risk-off environment. So we'll have to continue to pay attention over there. We have talked a lot about the ridiculous weighting on the top 5 companies in the market and the breadth issues that's causing. We're not seeing a broad-based rally. We're seeing, again, a lot of concentration in the top stocks and really in one sector, tech. And even when we look at the Nasdaq itself, I'd like to take a look at the breadth readings in that Nasdaq McClellan Summation Index. We ran into this resistance zone from back in the beginning of 2019 where we had that sharp sell-off. That is where we have decided to fail in terms of our breadth reading. And really since June, the Nasdaq continues to make new highs when we have a deterioration of breadth underneath the surface. This is a bit of a concern. And the data set that we're going to take a look at today, unfortunately, only has 3 occurrences on it, but it does make a very, very telling story. When we look at the S&P 500 with 4 straight weeks of 52-week highs and a negative McClellan oscillator going all the way back to 1962, we have 4 occurrences of this happening, right? 2 of them or really in the last year, one in 65 and one in 1998. If we look at the market 1 week later, we're positive 67% of the time across those three instances. 2 weeks later, not positive at all. 1 month later, 33%. 2 months later, 33%. 6 months later, 33%. A year later, 50%. Again, there's only 3 data points that we already have information for, so I wouldn't get overly excited about this, but it does give you that cautionary tale. When you are making new highs and you do not have the breadth to continually make those highs, meaning you only have a couple of names that are making those pushes, that is a concern. And you can see historically we have seen some moves lower because of that. Now, if we go back to 1998, again, we ran for another year or two before we ultimately rolled over. But the market cannot continue forever going up without participation across the board. It still could continue for quite some time. This is just another thing to stack into our, let's kind of have a cautionary mindset and be aware of what's going on as we move forward. As always, everybody, if you want to reach out, ask me any questions about the market, feel free. You can reach me at mtedeschi@perspectivewealthplanning.com, or you can pick up the phone and give me a call at 814-580-981. I would love to talk to you guys. As always, I hope this information was useful. I will see you guys next week. Take care.